Well, thanks to Chris, thanks to Stefan from my Singapore office as well for helping to put this together. And welcome everyone, and good morning from New York, that is. And good evening to everybody tuning in, Philip Futures clients and prospective clients. I'm looking forward to telling you a little bit about when I traded in the over-the-counter market, one of the ways that I would look at the market. So our topic today is ratio trading, and what we're going to cover today is I'm going to tell you a little bit about NYSE Life US first, tell you about the contracts and the specifications very quickly, and then we'll dig right into the trading opportunities, and hopefully this will stimulate some thought for you for further ideas. There is one more webinar in this series that I wanted to mention, and it is actually next Wednesday, and it's Gold Futures Arbitrage Opportunities, and there's the link there if you wanted to register for it. I'll also show this slide again at the end of the presentation, so if you don't get to it now, that's fine, and I know Chris will be sending out a flyer on it in any event. So NYSE Life US was started in September of 2008. We are a sister exchange to the very famous New York Stock Exchange, where the cash equities trade, NYSE ARCA, Amex, the NYSE Euronext exchanges, of course based in Europe, and as well another sister exchange is NYSE Life, which is the home of the European derivatives exchanges, also based in Europe and the UK. We have three asset classes, with of course precious metals being one of them, and the dominant contracts there are the mini gold and mini silver futures, which were actually the first contracts that were launched on NYSE Life US. MSCI indices are the foundation for our equity slate, and the emerging markets in particular are doing extremely well, something for you to look at hopefully. We do have an interest rate offering as well, and the dominant contract there is the DTCC GCF repo index, and if you trade interest rates at all, I encourage you to take a closer look at that very exciting contract, which won new contract of the year last year when it launched in July 2011. Our mini gold futures, the size is 33.2 ounces. The code is YG, and oftentimes people just say the YG contract. The tick size is 10 cents. So you made or lost $3.32 on a one lot position if it's moved one tick. The contracts are physically deliverable in the US. Most of the vaults are in New York, and one is actually all four of these vaults are in New York. Currently, just to give you a little perspective, the value of a contract is about $42,000 to $43,000. So gold is currently trading about $12.75 when I made these slides the other day. Now I know it's trading a little higher, but $12.75 times 33.2 gets you that $42,000 to $43,000 number. Initial margin right now is about 7.5% of that notional value, and the initial margin right now is 31.66. Mini silver, the code is YI. The contract size is 1,000 ounces, and the tick size is 1/10 of a penny. So a move of one tick on one contract, you've made or lost $1. Again, these contracts are physically deliverable in the US. And in terms of the value of the contract, the value of one contract right now, using $20 per ounce, I think we're trading just a little under that now, but $20 per ounce times 1,000 ounces, that gets you $20,000. The initial margin as a percentage of notional is 11%, and that's a bit higher than the gold initial margin as a percentage of notional, because silver is indeed significantly more volatile than the price of gold. Volume and open interest. Basically, April, fabulous month. The mini gold traded 34,000 contracts one day. That was a record for us. April and May, very good months. The market has definitely quieted down a little bit towards the summer. And just so you know, in terms of market characteristics, NYSE Life US is fully electronic. There's no trading floor at all. It's fully transparent. You and everybody else gets to see all the orders. We do have a trade matching algorithm, first in, first out. And I think an important point here is the participation is diverse. It's global. It's from around the world. And we also do have market makers providing regular, consistent market quality. And here is simply a link to a overview of the market. So when you have some free time, you can certainly take a look at that, and I encourage that. Key advantages. If you want to be trading a contract that is less than the full size, and NYSE Life US Mini Gold and Mini Silver is by far the most liquid. And well, why would you want to trade something less than 100 ounces in gold or 5,000 ounces in silver? Well, it just gives you a lot more flexibility. Obviously, on a proportional basis, they're going to be less capital intensive. It allows you to do some cost averaging, and maybe that might help you capture a bit more of the trading range. Let's say you wanted to buy at 1280. Instead of putting in an order to buy one big contract at 1280, you might want to try buying one mini contract at 1285, one at 1280, and one at 1275. And that way, if it never gets down to the 1280 level, at least you will have some participation in the market if you were able to pick up the 1285s. Just food for thought. So now let's get to sort of our main topic, and thank you for letting me provide that introduction and quick overview of how the contracts work. When I was trading in the over-the-counter market, this really was one of my favorite trades. And this is simply the price of gold divided by the price of silver. The sort of nickname for it is the ratio. I thought for our first slide it might make sense to take a look at going back a bit longer. So here is a chart of the ratio from the spring of 1988 until last month. And ironically enough, just taking that simple monthly average, it's currently 65.94. And ironically enough, the ratio is trading just a little bit under that. It's trading a little bit under 65 at the moment. So a major coincidence, but there you have it. But what I think this chart shows is the ratio really moves. A ratio is a bet on which metal will move faster than the other, or which metal will move slower than the other, depending on your position. Now, if we take a look at more recent price action, here is a slide of gold prices and silver prices, and what I really want to zero in on this slide is the historic volatility, to give you a sense of one of the key differences between the metals. The top part of the slide, the orange is of course the mini gold contract, and the sort of the gray is of course the mini silver. The price of mini gold is on the left scale here, and the price of mini silver is on the right scale here. Now, on the lower half is the historic volatility, and of course the mini gold historic volatility scale is on the left, and it is on the right for mini silver, just as you might suspect. So the message here is that volatility in mini silver is consistently higher than that of mini gold. Currently, it's not double, but it's almost double. Mini silver 10-day historic volatility is 31.37, and mini gold it's 18.33. And you can see, if you take a closer look at the chart even, the highest number on the scale here on the left for mini gold is 55, and it's 75 for mini silver. And you can see here in April of this year, when we had a very significant downward move, obviously volatility exploded, and gold volatility got up to about 57, and silver volatility got up to about 77. So big differences, and even here you can see throughout time mini silver volatility more than mini gold volatility. And that's important because when we put these two instruments together, you're actually going to wind up with something that's more volatile than mini gold, but less volatile than mini silver, which could be, you know, another appealing aspect of putting on this trade. The other thing that we definitely need to look at is the correlation between mini gold and mini silver. It's not 100%. And the top half of this slide here is, of course, our price action again, and the bottom half is the correlation. And over time, the correlation is 83.3, and this is going back to February last year. So here we can see that dotted line. That would be 100% correlation, meaning they move step for step. They always move together. But you're going to find that that's not always the case. Here we see that the correlation can actually turn negative a couple of times, and it can be less strong on certain days. Now this is this black line here is with a correlation of 0, and you can see actually there's been a couple of times, including one time this year, where the correlation actually turned negative. Now if you have a ratio position on, long one and short the other, you know, could this day be an opportunity for you? Or if you're thinking about putting on a ratio position. So, you know, just an important message that they definitely can move slightly differently and at a slightly different pace. And that's really what you're looking to take advantage of. Here is, you know, a chart that shows the trading opportunity that has been intact for many months. The clear view here is that it's been in a strong uptrend, and if the ratio is in a strong uptrend, that means that you know, one market is moving faster than the other, that gold is appreciating let's see, silver is going up faster or going down slower. So, you know, as previously mentioned, the ratio is a bet on the pace of the action. So with gold in the numerator and silver in the denominator, what I really want to say is the positive uptrend is if gold is appreciating faster or appreciating less slowly than silver. So that's what the message here is. There's a couple of ways that you could trade the ratio. Certainly one is by technical analysis, and the other is by fundamental analysis. here is very simply, you can overlay your favorite technical analysis tools to trade the ratio. When you put together two commodities, you can definitely use your current tool set. So here, all I did was put on the 30-day moving average and the 50-day moving average. And you can see here that the 30-day moving average is in green, and you can see it is moving very nicely, and the 50-day is in the blue. And as with sort of any trend following with using the moving averages, if the shorter moving average crosses the longer moving average, you know, that depending on the direction, that can be bullish or bearish. So here, right here, the green, the 30-day moving average crosses the 50-day moving average on the upside. And right about here, that would be a signal to get long the ratio in that market. So that would be an indication for you to get long the ratio at about just under 50. And you would hold that all the way until the moving average, the shorter moving average, crossed the longer moving average on the downside. And that would be right here, and then you would have ridden that long ratio position to about the 56 level, 55, 56 level. So message here is you can definitely use the ratio positioning trading using the fundamental analysis. Using technical analysis, excuse me. Fundamental analysis is the other way to take a look at trading the gold-silver ratio. Now, in our first webinar last week, we talked a lot about the fundamentals, supply, demand. You know, this webinar, I just put in one slide about it just to give you some perspective. Why these two metals can trade at different paces, and they definitely have their own fundamentals. So here, just very, very quickly, the gold market demand, 43% of it is made up of jewelry, 35% of it is made up of investment, 12% of it is central bank purchases. So that's gold. So gold is much more of a monetary metal as compared to silver, where fabrication, where people making things, makes up 81%, including industrial applications of 44%. So if you are bullish on the economy, bullish on growth, bullish on the fact that industry is going to be needing more commodities and so on, you might want to be long silver and short gold, because if the economy is doing very well, perhaps there's less reason for the safe haven nature of gold. If, on the other hand, you think the economy is going to continue to be very weak, there's going to be strife around the world, you might want to be long of gold and short silver because of its industrial applications. You would think the economy might not be doing as well. So that's an example of using fundamental analysis to trade the gold-silver ratio. Well, how exactly do you put on a ratio trade? Well, to go long the ratio, you buy gold and you sell silver. To go short the ratio, you sell gold and you buy silver. So basically, whatever you're doing to gold is your ratio position. It's a very important point here. Positions should be in approximately equal notional amounts, and you'll probably have to use a few contracts. The good news here is that even though you're using multiple contracts, there are significant margin offsets. And the general guideline for OCC, who clears our contracts and sets the margins, you get 70% margin relief in a series of 3 mini gold to 5 mini silver. If it turns out that the best number of contracts for you to have is less than that, you still capture significant margin relief. For example, with gold at $12.75 and silver at $20 an ounce, the gold contract notional value would be $42,000 and the silver contract notional value would be $40,000. The initial margin for having one gold contract on and 2 silver contracts on is less than $3,000 instead of the nearly $8,000 for the gross position. So, I think that's one of the most important takeaways that we will discuss today. Let's take a minute and walk through a P&L example. Here we've initiated the ratio long, so long gold, short silver. We decided to go long 1 mini gold contract, short 2 mini silver contracts at 63.75, and it turns out we liquidated it at 68, so we made money. So here our direction is long mini gold, the number of contracts is 1, contract size, as you'll remember, is 33.2. For simplicity's sake, I said let's have the price of gold not move. So I initiated this position at $12.75 and I liquidated the position at $12.75. So I have no P&L related to my gold position. I went short mini silver in 2 contract sizes. As we remember, 1,000 ounces is the size of the mini silver contract. But silver prices, I initiated it at $20, actually went down quite a bit to $18.75. So this is simply the math. This is how much I made. I made $2,500 on 2 contracts. And I made nothing on my gold position. So my P&L of my ratio trade, in this example, would be $2,500, obviously less any brokerage or exchange expenses. Let's take a look at another example. Unfortunately, this one doesn't work out quite as well, but there's an important message here, too, beyond that. I decided to go short the ratio, so I'm short 1 mini gold future right here. Contract size is 33.2 ounces, so I'll be 1 times 33.2. And in this instance, I initiated my short of gold at $12.75, and I had to buy it back at $13.60. So I lost $2,800 here. In my silver position, I went long 1 mini silver. I went long 2 mini silver futures contracts times 1,000 ounces, which is the contract size. And again, for simplicity's sake here, in this example, I kept the price of silver the same. So there was no P&L. So envision that silver really didn't move and gold rallied. And I'm short the gold, and I'm long the silver. So I lose $2,800 here. Now, I deliberately initiated the position at 63.75 and liquidated it at 68 in both examples. I just flipped back one slide. And what you can see here is, depending on which metal moves, the P&L is actually different. In the first example, I'm long the ratio at 63.75 and liquidate at 68. I've made $2,500 because what's moved is the silver price. If we go back to our second P&L example, it's different, even though the ratio numbers are the same, 63.75 and 68, because it's a different metal that the P&L is working on. If you want more information about the ratio, I had recently written up a commentary about writing it in more detail. Here's the link to that article on our website. And please feel free to click on that in your free time. And if you have any questions, my email address will be at the end of this presentation. I'd be delighted to walk you through anything. And actually, I'd love to hear your feedback as well. So that is really the ratio, the price of gold divided by the price of silver, and how you can trade it. And I think that you can identify some opportunities there. The other part of this webinar is really a bit conceptual, which is treating gold as a currency. And this is important too, because it really is, if you're going to incorporate that into your trading, it is also a bit like ratio trading. Here is the price of gold in the orange and the price of the Dow Jones Industrials, the equity index that's quite popular in the United States. And what I have found is that many hard asset investors like to keep track of how much 1 ounce of gold can buy of an equity index. Obviously, you can substitute for the Dow Jones any equity index that's important to you, or SHFE, anything listed. So here you can see that there's a strong inverse correlation. And the next slide here is simply the price of mini gold divided by the Dow Jones Industrial Index. And you can see here that the purchasing power, because the price of gold has been weak, as we know, in the past several months, really since October of 2012. That's kind of when the indications of a bear market started. The price of gold has been declining, and the price of equities have been surging higher. So this has driven the ratio down. Now, is this an opportunity? Is this an opportunity to perhaps buy gold and sell equities, or is this an opportunity to continue with the trend? This is the kind of thinking that might be interesting to add to your trading. A more popular way to use gold as a currency is with another commodity. So here is mini gold and ICE Brent crude oil, right? And again, you can use any commodity that you know well. And in fact, you should. The commodities that you know best, it would be interesting if you could take a look at them through the vision of pricing them as gold as the currency. So you can see here that the bottom part of this slide is the correlation. And you can see there is a positive correlation between gold and crude oil. It's not tremendous. Here it is. It's not even a half at the moment. It's 0.2. But you have to see now, see when it's gone negative? You have to identify, is this when there are opportunities to put on a ratio position? Is this where you might initiate? Is this where you might initiate? So we can see here that, just very quickly, ICE Brent traded as high as $146 in July of 2008. Mini gold was trading 607.20 in 2007. ICE Brent traded down to 36.61 in 2008, and mini gold traded up to $1,900 in 2011. So we have some correlation between these commodities, at times stronger than others, and occasionally a negative correlation. Are there trading opportunities here? This is the ratio of mini gold divided by ICE Brent crude. So what you're seeing here is how many barrels of oil can you buy with 1 ounce of gold? And you can see here that the The low of this ratio trade would have been in 2008, June 12th, when mini gold divided by ICE Brent traded as low as 6.39. So mini gold would have only bought less than 7 barrels of oil. Mini gold per ounce would have bought 6.39 barrels of oil. That's when, just to give you a little perspective, that's when mini gold was trading about $869.40 an ounce, and Brent was trading $136.09 a barrel. The high side of this trade was in February 2009, when gold prices were extremely strong compared to oil prices, and you would have been able to buy almost 25 barrels of oil for an ounce of gold. Mini gold at that point was trading $978 an ounce, and Brent was trading just under $40 a barrel. So that really is my food for thought today. Hopefully you'll think about incorporating the ratio into your trading. Hopefully you'll think about using gold as a currency. Some people actually use silver as a currency as well. Some people look at silver versus equities and silver versus actually some of the energy contracts as well, because obviously energy contracts are highly industrial, and of course silver is as well. So there could be good patterns for you to pick up on there. A lot of my job is education, and I do some writing, and here are some recent articles that you might find of use. Something about the London gold and silver fixes, gold's role in risk on and risk off, and so on. And you certainly can click on those links, and you're more than welcome to read anything you like. Here are the contacts for my offices around the world, depending on your area of interest, and of course I'm at the bottom. And as I said before, you are more than welcome to drop me an email, jropiak@nyx.com, and please let me know if you have any questions. And with that, I'd like to thank Chris and pass the webinar back over to your control. Thank you very much, everybody, for dialing in, and I hope this was a useful presentation. Thank you.